talking about portfolio predictability and what Diana told. So in a previous lifetime, I spent over 10 years working as a hedge fund manager before moving into the startup world. And looking at metrics, managing different assets was basically what I was doing. Trading all those assets was what I was doing on a daily basis. And a lot of this, I started to, after I sold my last startup, worked for a venture builder, and decided to start working with innovation consultancy. And that just started to hit me when I saw there were like no metrics, not many things being done around that in innovation. It's okay, how can I actually bring a lot of this knowledge that I have that can generate impact? So I started to put the dots together and say, okay, how could this work there and there? And that's where the whole, let's say, backbone of what Trimaran is today is all about, and what all the consultancy work we've been doing has been on top of. So I want to start first telling you exactly like what is portfolio management, right? Okay. So I looked that up. I didn't know this by heart, but at Investopedia, it says it's the art and science of selecting and overseeing a group of investments that meet long-term financial objectives and risk tolerance of a client, company, or institution. So to start, I want to say that the art and science, right? A lot of people say, oh, you understanding innovation and choosing the right startups, et cetera. It's an art. Venture capitalists say that. Yes, there is a component to that. The human factor, the hunches, it's always there. I don't eliminate that. But there's also a lot of science behind it. And selecting and overseeing a group of investments. I highlighted investments because I want to talk to this as a portfolio. When I talk about portfolio, I talk about a portfolio of financial assets, right? You can say that, oh, I have a product and service portfolio that I offer my clients. I create my portfolio and X percentage goes to B2B companies, X percent go to B2C. And you can classify portfolios in very different ways. Here, we're talking specifically about financial portfolio, looking at them as financial assets. And also, the goal of the portfolio and a lot of the goals in what we do is to, once you have that portfolio structure in place, when you look at financial assets, one of the goals is to actually minimize the risk inherent in your portfolio and at the same time, maximize profitability. So creating that goals. So then that meet the long-term financial goals and risk tolerance. So risk tolerance, let's hold that for now, but long-term financial objectives, you're going to ask me like, okay, but in innovation, how do we kind of do that? It's a big question mark. It's already very hard to measure any kind of short-term results, let alone long-terms, ROIs, and et cetera. And that gets even more complicated if you have a multitude of assets, because within the innovation umbrella, you have many assets in all their different shapes and sizes, all have big potential, right? Otherwise, they wouldn't be there in the first place. But they're very different. They're different stages. It could be an idea. It could be a core product. It could be anything between the MVP and a scale-up. It could be open innovation. How do you connect them together? So the exercise I want to do here is, okay, let's think about other kinds of portfolios. So what about our stock portfolios, right? We invest our money in all these very different companies, and they are different assets, right? So what brings them together as a portfolio? So we're looking at, it's the price at a high level, but basically all the other indicators that are derived from the price or are derived by the price, derived from the price. So we're talking about the price earnings ratio, future cash flow, costs, earnings per share. And in the end, the price is nothing more than the price per share, which is that unit value of the monetary unit of what the company is worth, right? Well, how much one share is what is the value of the company. And the same goes for real estate assets. You have many different kind of assets. You have A, B, C, class grade listing, single family unit, commercial real estates, multiple units. And they all come together underneath the same portfolio through the value that is created. And you get to that value measuring the square footage, what are the cap rates, what is the debt coverage ratio, the cash on cash return for each of these individual assets. And that's how you start to compose your portfolio. And once you understand the value of the asset that you have in hand, you can understand what is the value of your overall portfolio. And these metrics together, they allow you to have what the key element in any portfolio needs to have, which is comparability, right? And so, for example, you want to invest a little bit of your savings into stocks, and you want to decide, okay, do I invest in Apple or Berkshire Hathaway, two completely different assets? So you can, for example, look at their price earnings ratio, and you already know immediately which could potentially be more overpriced than the other. And a very important point here is that, once again, these indicators, there's no silver bullet, right? There's a tons of other variables that you take into consideration, where which market is growing faster than other, what is your, even your initial hunch, right? Like the art part comes in as well. Okay, I believe this is going to have a bigger potential, etc. But most importantly, they allow you to understand, based on your long-term financial goals and your propensity towards risk. So you're going to balance these two. First of all, where do you allocate your resources, right? And which of these assets are overvalued and which of them are undervalued, which is what is arbitrage, which is a lot of what I did in my times as a hedge fund manager and trader. I used to find stocks that had some correlation between them, high or low. I would do both, and identify which was the one that were overbought, which was the one that were oversold, and I would do the inverse and gain exactly that and arbitrate exactly that difference. And also it helps you diversify, understand how balanced your portfolio is, and also because these assets, they change value with time, they help you, right? So companies are growing, ventures are moving forward, they're doing tests, validations, getting customers, etc. Having these metrics in place, they also help you understand and rebalance your portfolio, all of it, and all of this together according to your innovation thesis, right? That's why it's so important to have a very clear innovation thesis. The investment funds, they have their investment thesis as well. Either if it's in equities, in real estate, etc. They know where they're going and what they want to achieve. But then you can just say that, oh, okay, that's really easy because all these indicators that you showed to me, they're financial indicators, right? These are sales, revenues, cost, debt, but where are those financial indicators in innovation, especially in early stage innovation? Yes, a lot of times you don't have them. Most of the times you don't have them. But you do have other kinds of measurements that come to use. And that is exactly when risk comes into play, right? So when you start using innovation metrics, they become a relative measurement of risk, right? Let me explain a little bit what that means. If you measure risk of a specific venture in itself, let's see, for example, how fast they're validating or invalidating all their assumptions, all their key hypotheses, right? You know, okay, I'm running X experiments per week. These are the numbers of hypotheses I'm validating, invalidating, but in itself, it doesn't mean much. But once you start to look at it from a portfolio perspective, now say, oh, okay, I am de-risking this really fast, but there's this other asset that I have here that is moving a lot faster. So now when it's time to decide where I'm going to allocate my resources, I have the means to compare between those two. So, and when you start talking about risk, If you've seen some of my papers, my talks that I do, I always bring this, what I call the de-risking hierarchy, right? There is a certain hierarchy innovation ventures need to go through while you're developing the product, you're invalidating your assumptions, you're uncovering the new business model that's coming out, because, right, that's what innovation is about. You need to discover what your new business model is going to be until they're ready to scale. And throughout this de-risking hierarchy, you have specific stages, and each of these specific stages have their own specific metrics. So let's say when we're talking about very, very early stage, through the ideation, where you're going through the problem validation, identifying problem customer fit, velocity is your key component, let's say your North Star metric there, right? When you go, let's say at a later stage, where you're already close to scaling the product, close to a Series A, you're already talking about monthly recurring revenue, what is your customer acquisition cost, lifetime value. These are the metrics that start to play a bigger role. At the MVP stage, you're doing getting your first revenues, which is not exactly your recurring revenue just yet, and all the other traction and growth metrics that happen in between from MVP to scale. So that's where things start to get a little tricky. I also have a big paper on closing the gap between MVP to scale that I talk a lot about that, which you will get from the Innov8rs goodie bag as well. So now that we understand these different metrics for these different stages, and you start to look at this from a portfolio perspective, this is what you start to identify. So, okay, I have all these ventures at early stage that I'm measuring the velocity, all these a little bit more advanced that I have already traction happening and a little bit of revenue, and something in between, which is velocity and traction. So you start to identify, you start to separate the apples and the oranges and look them all together within the portfolio. And of course, on the left, I like these I call them like the overall pre-metrics, just that you to get start with an idea is like, okay, does it have a big market size? Is it potential for distribution? Does it have big gross margins, network effect? Basically, everything that has a potential to blitz scale an innovation venture. So once you have that, then you can start organizing, analyzing, and balancing your portfolio according to that, right? All your different innovation assets. So you can, this one, for example, I just put it there for funding allocation, right? You can see how much money I've invested in the early stage, how much is H1, H2 innovation, how much is H3, but this can also be by ecosystems, by the industries that you're investing in, by stage, by the business model, B2C, kind of like those examples I gave in the beginning. So to get this a little bit more clear, I'm going to show you now how we apply this within an insurance company, one of the top insurance companies in the world. And basically, we have them identify the odds and create portfolio predictability. So they came to us with a challenge that they had this open innovation and closed innovation. They had internal ventures and open innovation portfolios already somewhat organized and advanced, but they had these long-term financial goals that they're like, we don't know if we're getting there, we don't even know if we're far or close to getting to them. So what we started doing for them is, okay, how do we allow the portfolio comparability and create an optimized management strategy for them for the portfolio, identify exactly what are these gaps to the long-term financial goals, and start creating predictability. So the first thing we did was started implementing a validation framework and progress metrics, right? So the goal here is to tie from the first assumption and hypothesis validation, ever an idea started, all the way to when you scale up your product or it is a full-blown reintegrate into the mothership core product, right? So this is how you connect all these pieces together and you can start managing your portfolio. So the first thing we did, we created a specific opportunity scorecard for them. I'm sure most of you already seen similar tools like this. Basically see, okay, what is the market size? What is the potential gross margins, network effects, et cetera, so that can be scored. And so even at the idea stage, you start to have a little bit of comparability through all the ideas. If you have, let's say, an idea software that crowdsources ideas throughout your entire corporation, now people just start having they can start scoring, and they don't even have to come to you to say, oh, I have this amazing idea. Now they are actually bringing proof from it, and not only from these scores, but then the second step is we created a hypothesis database and risk scoring, because this first data, a lot of it is market research, but a lot of it is still a big assumption as well. So they go into this hypothesis database where they can evaluate, okay, is this high risk for the business? Is it the low risk? Does it have a big impact? Kind of what Diana did a little bit in the beginning here. Everyone scores it, and then we help them automatically identify which could be the most riskiest assumptions, so that they can speed up the process to just go and start doing the testing and the experiment management. From that point on, we help them create another scoring point, very easy, from a 5-point score base, from confirming to disconfirming to all the evidence that are attached to these experiments, to the hypotheses that are being tested, right? So if you have, for example, if you run an experiment and you go run some surveys, you ask your wife, your husband, your partner, it carries one weight. If you go ask to 10 different customers, it carries a different weight. Nonetheless, these are two very valuable evidence that you're going to bring to your hypotheses. But now you can actually start weighting them, and this starts to help you see and help you move forward. Okay, do I validate? Do I don't validate this? And all this starts to come together with within an overall project metric. So, right, so the project manager, they're looking at this. Okay, this is the total obtainable market that I think I can get in 3-5 years. This is how much I want to take of it. This is how fast I'm de-risking these ventures, de-risking, invalidating all these hypotheses, etc. How much money I already have allocated, how much money I still have left, and so forth. But as I said before, this in itself doesn't mean much. It's a good guidance. But then we open them to the venture metrics portfolio dashboard, right? So here is where they started to see, we present to them all the venture that they had together, and this open innovation, internal venture, etc. But we brought them into one single, let's say, base for comparability, which is the de-risking hierarchy. So now they're looking, okay, at what stage they are. Did they validate product customer fit? Did they validate product, are they already in product market fit, etc.? What is the size of the market? And not only that, we developed a visual tool for them so that they see very clearly these stages and easily shift and say, okay, I want to see now based on the industry that I'm going, based on the maturity level, based on velocity, on market size. So now they start to have more and more information to understand, okay, do I move these ventures forward? Do I kill them? Do I pivot? And also see those cohorts very clearly. And very importantly, after that, we started to look at the stage conversion rates, right? And we looked at the conversion rates they had initially, which was just, okay, how many goes from ideation to pilot to MVP and to scale? But we also brought in a vision that is a lot more customer-centric, which is, what is the conversion rate from each of your, I like to call it traction fit, which is basically the problem customer fit, problem solution fit, product customer fit, and product market fit. Because these conversion rates, when tied to the growth metrics, depending on what stage they are, and some key assumptions. So let's say, for example, the expected revenue, and this could be based on historical data from some more mature startups they already have in the portfolio, or simply the obtainable market, the percentage of the market size that they think they can obtain, the average time to validation, the number of ventures being developed simultaneously, number of team, et cetera, capability of building ventures, and quite a few others. So putting these metrics and these key assumptions together with the stage conversion rates, they allowed us to create a financial model that begins to tie project level metrics to portfolio level indicators, right? And ultimately to the long-term financial goals. So now, as I said before, we're tying the end result, the financial result, to hypothesis number one, that we're starting with venture number one. And this can be a ton of ventures and so on. So now on the left, you can see the overall expected portfolio return. You can see them per stage that they're in. So how much is, let's say, is expected of revenue or its actual numbers that already came in. And we're also accounting for the time to maturity, right? So for example, if I put in a venture in my funnel today, it will only start generating revenue in let's say 12 months from now, like recurring revenue. So all these assumptions are built into the model, and then you begin to create your portfolio predictability, right? So we also created some very easy visual to say, okay, this is the overall turnover that we're having. This is the what's the year-over-year performance for each venture individually, and then this altogether allow them to clearly understand how each venture is now contributing to the overall portfolio. So something that was done, they were flying without instruments, doing very ad hoc basis. Projects weren't talking to themselves, between themselves, right? The portfolio management role, let's say, wasn't really there because things weren't integrated. And now, not only we will allow them to see, okay, this is the contribution each venture has, but we clearly show them, okay, this is the gap that you still need to fill based on these key assumptions, the projections that we now have to reach your 3-5 year long-term financial goal, right? And this got even to a point where we understood how many, like their head count on how many ventures and ideas they could start running, ventures they could build or partner or investing at the same time. So based on these variables, we even created what we call the pipeline vitality indicator. So now we're saying, okay, based on your capacity, based on your bandwidth, these are the number of ventures that you still need to bring into your portfolio to the beginning if you start them today as an idea, so that you can reach your expected financial returns in the long term. So basically, in a nutshell, that's what we've been doing for the last few years. That's kind of how I combined my years as a tech entrepreneur and as a portfolio management to start bringing to big corporations these new tools, these new ideas to implement and optimize their portfolio management practices. And also, right now, not right now, but we've been always thinking, okay, how can we bring this knowledge not just to everyone? Because I think I have this from my entrepreneurial days. I want to gain scale fast. I want people to learn this as fast as possible, right? So we can help out. I do believe that corporations are one of the biggest agents for change in the world. So I really want to be an enabler of that. And so right now we have everything that you've heard me speak about here today. We can talk. You can send me an email. We can have a long discussion. But also, you can. We have just launched the Corporate Innovation Academy, which is a self-paced online course with all this content that goes all the way from building innovation thesis all the way to portfolio predictability. We have just launched that, so you can just go a self-paced course. It takes about 10 months to go through 3 modules and 12, 20-minute micro-learning lessons, over 100 classes. And you all have a 35% discount. Cohort number 1 starts in September now, and there's an early bird bundle to get all 3 models until this Sunday. So you can, and the 35% discount applies on top of that. So just go to the corporateinnovationacademy.com or just send me an email, and I'll be glad to talk more about anything that we talked here. And thank you for being here, and I hope this was a little bit inspiring. And if you have any questions, I'll be glad to answer them all. Thank you.
Thank you so much, Rafael. I love taking that financial metaphor and applying it to innovation, which feels so fuzzy most of the time. We do have one question in the chat. Everyone else, while Rafael is working on this question, I invite you to put your question into the chat. I have a bunch that I'll save up and go last in case we run out of questions. I don't think that's going to happen. So I'll email them to you later, Rafael.
No problem.
Here's Andreas's question. Are you presuming the venture or portfolio are separate and independent? Should the full picture not also include dependencies and correlations? Otherwise, you might miss out on opportunities when risks wash out or additional bulk risk.
So if I got this correctly, you're talking about, let's say, how does one venture potentially, you're talking about diversification. Is that it, Andres? So how you can, how does a portfolio combined all together balance each other out? And then, because of course that will have impact on the end goal. But just to be clear, is that what you're talking about?
Yes, I was building a little bit on financial theory. When you look at a portfolio of venture or projects or products or whatever you name it, in some cases, different projects might build on some shared resources, for example, or shared leadership or so. So if something goes wrong there, not only one is affected, but more. And then you have an additional risk. Vice versa, you might build ventures, projects, products with that to chase alternative options because you simply don't know which one is going to work out. And then the risks are washing up. One goes bad, then the other one goes up, right? And to really have a full picture, you want to incorporate all of this somehow in the model. But it's easy when you talk about shares and financial instruments because it's numerical, you can do that. But in real life, projects, ventures is a bit more difficult. And that was my question. How would you do that?
No, absolutely. That's a great question. I think going and I'm a metrics geek. I love all this. And I've thought about, I'm thinking about, how do I diversify my portfolio? All this went through my mind already. And I decided to, let me just take a step back and not go too deep into that because I think most companies today, they're let's say a couple of steps behind that stage. And even before you start to understand how do concentrated projects underneath one single division and let's say more diverse projects balance each other out. I think the best idea is to see, how is this affecting risk of the portfolio as a whole, right? So for example, does it really make sense to have all these projects that so tightly correlated together that if one falls, another falls together? Because then you're as you said yourself, you're increasing the overall risk of the entire portfolio. That's right. You can get already a hunch that when you look at the portfolio as a whole, that is having a hefty impact, right? If you a little bit more simple example, like now all the companies are saying, how do I get 100 ventures in my portfolio to act like a VC? But before they were doing 5 ventures with a massive amount of budget. And that's exactly what you need to look at. How am I addressing my investment in the first place in innovative ventures, right? Because if I am doing 5 massive projects with huge budgets, my risk is off the roof, right? But if I am doing a lot of small bets, So I think before understand how they correlate, I think it's good to see based on my innovation thesis, do I have the right structure in place to get to where I want to go in the future? Does that make sense?
Yeah, clear. Yeah, thank you.
Sure, you're welcome.
Great. Renata has a question. There is a prerequisite to create the innovation portfolio, that there are quite some processes, for example, documentation of experiments, et cetera, that already need to be in place. So when is the best time to focus on creating this innovation portfolio? In other words, at which maturity level should the innovation team be to make sense to focus on this? Renata, please feel free to unmute. I hope I didn't butcher your question.
Yeah, no, I mean, I'm not sure if it's clear what I mean by it, but I was thinking of an innovation portfolio as well. And indeed, what I realized was that a lot is manual input. It's not like a normally, conversion funnel optimization dashboard for an e-commerce. So quite a lot of it is what someone thinks. And that also comes with, and now I saw that a lot, it was about experiments and which experiments, how far you were with that. So it means that you need to have those sort of tracking processes already in place for to be able to provide data into this innovation portfolio. And when an innovation team is really new, maybe they need to focus more on setting up those processes in place before focusing on some tracking. And I wanted to know what was the Rafael's thought about it, and when he thinks there is maybe it's the best moment, where is the best moment to actually start thinking about the innovation portfolio?
So what we like to do with our clients that let's say are more in the early days of having let's say a structured approach to innovation management is to help them. We like to measure things from day one, right? And of course, it's not to bring in a ton of metrics just for the sake of it, because it makes things slow. And a lot of the time it's not really going to answer the questions, right? They're just going to, once, as I said, it's not a silver bullet. It's just going to point you to some directions of what something might be happening. But I think it's very critical to have it from day one. First of all, once you have the right processes in place and everyone knows exactly what they need to measure, you can start testing ideas on every person's desk. They can just say, okay, oh, I think I have this great opportunity for a venture. Let me just call 10 clients and et cetera. They know, okay, I did this in 10 days. I did that. I got this evidence and et cetera. And okay, I need now 50K to start doing this. And this is what I've got so far. So that's why I really believe it as soon as you can do it, the better you can manage it. And also you can leverage the network of your entire company. So if everyone knows this process, everyone can start building ideas from scratch. And then you can use that network effect to, let's say, widen your top of funnel ideas coming in. If you, for example, don't have manpower enough to build 20, 50 different ventures at once, but you can widen the number of ideas coming in and the quality of them, which automatically will increase your conversion rates, because now better ideas, more validated ideas are coming through. When you start to think of, it's interesting to see metrics from day one and at least have a vision of what you want as a portfolio. Because then again, if you don't have the data isn't being generated yet, and you don't have people aren't really familiarized and into it and doing, because then again, this also is there's a learning curve to it to do this more frequently. It doesn't really matter saying, okay, we're going to do this, we're going to combine all these together. If you only have capacity to run 3-4 projects, right? There will be some information, but I don't think it's going to be cost effective in regards to the time and energy that you'll have to put into it. I don't know if that clears a little bit your question.
Yeah, thank you.
The next question is from Susana Gerardo. I hope I'm pronouncing your name correctly. Excuse me. When you estimate the contribution of the startups, do you apply any correction to the size of the opportunity according to risk, maturity, etc.?
Hey, Susanna, how are you?
Hi.
Yes. Can you just elaborate a little bit?
Yeah, sure. So basically what happens with the startups, internal startups, and particularly is basically when they start, they estimate how big is going to be the size of opportunity, how many revenues they potentially can contribute to the whole portfolio of the startups you're building. But usually this amount varies with time, because you start with a lot of uncertainty and then it becomes clearer the size of opportunity you're going to be able to achieve. So, I mean, when you tell the teams, okay, of the startups, estimate what's the size of opportunity or the potential contribution that this startup might have for the company, do you apply some sort of correction and, let's say, percentage of saying, okay, they say they're going to make, let's say, 100 million, yeah? But they are saying it, they've just started, they have made kind of so it's not really mature. There is a lot of uncertainty. So let's apply some sort of correction factor and say, okay, let's say we will really make probably not more than, I don't know, 50 million from what they are saying. But as the startup matures, you can really understand better what the size of opportunity is going to look like, and that percentage or that correction factor you apply should decrease because you also have less risk as well. So do you do something like that with the?
Yeah, exactly. We do. So these are all embedded in what I call the conversion rate. So these are not just how many startups you pass from one phase to the next, but also exactly what is the discount that you're giving. So, for example, if you're talking about very, very early stage in the idea phase, I think Rafa, it was about like what 80% that we're giving on a discount. So to be very conservative, it's like, okay, you're saying that it's 100 billion markets. Okay, so we're gonna chop off 80 of that. You were talking about a 20 billion market. So things can really be, because as you just said, as the more de-risked they get, that number starts to widen up as well. And of course, it connects to how fast you're moving your ventures from one stage to the next.
Okay, thank you.
Okay, great. And Suzanne has a question. And do please unmute, Suzanne. I'll read your question and you can clarify from there. Do you see the innovation portfolio as something dynamic and agile, or something that is set up early on? So, for example, in annual strategic planning. If it's more like that, the annual version, do you have any tips on continuously reprioritizing?
Thanks. I don't have any clarification unless the question wasn't clear.
No, it's super clear, Suzanne. Thank you for the question. So yes, I do. I wouldn't say agile, but it is definitely dynamic. It definitely moves. So if you're moving, you can start 1 year with an idea, and that's, I think, the whole point about innovation is speed, right? So especially the early stages. So you start an idea at the end of the year, you probably have already a Series A company ready to scale, right? I've seen companies in 12 months already getting their Series A funding because they already had recurring revenue, et cetera, and they had already 50 employees and blitz scaling, right? So what happens is, I don't think you're going to be rebalancing this constantly. That's what the whole rebalance is about. Even for stock portfolios, this rebalancing usually happens once a year. So what I think once a year is a good timing to look back and say, oh, okay, what happened to my ventures? Probably quarterly, you're going to be adjusting them individually or be looking at that, but to effectively say, oh, okay, now let's say all the ventures that we decided to go into autonomous vehicle driving or blockchain, they really grown massively. And this was supposed, based on our portfolio thesis, this was supposed to have 20% of our portfolio, but because they grew so fast, they now account for 35% of the portfolio. So now maybe it's time to look at, okay, what do we do? Do we spin them off? Do we incorporate them back into the corporation and so forth? So that's when you start to look and say, okay, how do we start to rebalance and go back to what is our initial thesis and et cetera? I hope that did I answer your question?
Yeah, thank you.
Welcome.
Great. That's the last question that we have in the chat. Is there anyone else who has a burning question? Feel free to just unmute and ask your question. I have a few, but we're going to give some wait time.
And you can all just reach out to me. I'm on LinkedIn. I'm very active on LinkedIn. I think my contact with my email will go to them as well, right?
Kate will have to answer that question, but I think so.
Yeah.
Okay, I'm going to ask my question now. One of my questions. I have several. So I want to go back to that very first analysis that you invite people to do. You had feasibility as one of the measures maybe it's not the very first one, somewhere in there you had how feasible is it?
Yeah.
Can you talk about how you invite people to measure feasibility at the beginning of a project?
I don't, to be completely honest.
Okay.
Because for some industries, for some ventures, that is very critical, especially if you're talking about engineering, more hardware companies. So I just put that in there because, okay, sometimes the process isn't as fast. Sometimes there needs to be a look, okay, is this really feasible? And even for, let's say, software or other kinds of ventures, you can usually just do like a top of mind guess and say, oh, okay, I have the market size. I know how much I might spend just to have a team running this for a year. I know I have a guess on to build my traction model to see, okay, how much revenue can I make in a certain period of time? Does revenue, for how long, right? I can go with a negative cash flow and when this becomes so not only feasibility of building the product itself, the technology, but also business feasibility as well. So I think that's always something.
The runway.
Yeah, but I don't have a specific, let's say, framework or a process for that because it just varies a lot.
Fair enough. I don't know what it would be, so I was hoping you had a magic wand.
Sorry,
but no. So that helps me see that what we're doing here is taking some of those things that are gut checks and formalizing them, putting them into a comparable framework.
Yes.
So at least I'm doing the same. Yes, it's a gut check, but I'm doing the same gut check for everything.
Yes. And then going to the market and test and
then the test.
Validate, right. But yeah.
Yes. And watch that. I made that guess about my runway. What's really happening to my runway?
Yeah. And as you move forward, those numbers change, right? Those numbers, that's when you start to adjust your leverage. Say, oh, I thought my conversion rate from pilot to MVP or from a product customer fit to product market fit would be 1 out of 10. And we did 3, amazing, and they're doing great. Can we repeat this now? So let's shift the levers and see what this will do to our entire model.
Yeah. All right. Any last questions for Rafa? Anybody dare to give an anonymized version of a really specific thing that you're grappling with? Okay, I have another question. I'm sorry, it leaked in just here at the last minute. I'm thinking about, at the Corporate Accelerator Forum, we talk a lot about the frozen organization. Sometimes the innovators are sort of ready to go, but it's hard to convince the top, or it's hard to convince the top and the frontline innovators are totally clear, and the middle managers have a challenge. Do you run into that with this work? Or is this a key to unlock that connection to have everybody on the same page?
I think it's one of the keys that the middle management, let's say, loophole. I think it's quite a big challenge that a lot of companies face because there's a lot of discussion. Okay, this innovation, is it top down? Is it bottom up?
Yeah,
doesn't really matter because it just gets tangled in the middle. And I do believe it's a little bit of both combined. But I think that before understanding all that, before understanding if it's what kind of portfolio you're going to run, how you're going to optimize all those things, a critical component that I don't see a lot of companies having actually is having like a clear pathway from idea to scale, right? So if I'm in the back office accounting cubicle, just doing my accounting stuff there, and I have this massive idea that can bring tons of revenue to the company, I don't know what to do with it. And they'll probably die. If I'm very persistent, I'm going to knock on a few doors and they're going to probably, if they block me, and if I'm really, really persistent, I'm going to go out and build it on my own because that person has already the entrepreneurial thing in it and probably is going to be a success. So I think one of the key components that these companies need to have is, okay, if you do have an idea, this is what you're going to go through. These are all the steps that you need to happen. These are the people you need to talk to in between, right? You have already your let's say your flow, your ecosystem build. HR is going to help you out. Procurement is going to help you out with whatever you need. So that is already in place. So then you can go. It's still good. You're still going to roll that massive rock uphill. Don't fool yourself. But at least you know where you're going and what you're going to take to get there. So I think that for me is the key thing that a lot of companies miss out on.
Great. Fantastic. Right here at the end, Andreas has one more question. Would you go so far as to say that you start with a portfolio because you don't know better, then you proceed, and at milestones, you kill one after the other, all the ventures until you have the winning one, and you bet your kitchen sink on it to maximize the outcome?
Yeah. Start, roughly speaking, I don't know the size of the company, et cetera, but start as many small projects as you can, and because it's not a pipeline, it's a funnel, right? And you do kill it the same way you're killing your hypotheses at a project level. I like to say you apply lean, the concepts of lean at the portfolio level. You start killing your ventures as they move forward, you invalidate them or you pivot, et cetera. Then you start saying, okay, these are moving faster. Then you just start narrowing that funnel. And when you do get to the top end, okay, these are de-risked. These are the ones that have proven themselves. Okay, now let's double down on them and reap the rewards. That's what VCs do.
Great.
On follow-up.
Well, thank you so much. We are at the end of our time here today. Kate has put the link in for the next session, so you can pop right over there. And she's also going to, excuse me, she's ahead of me already, put in the link for the discussion. So any insights, questions, comments that you care to share, there's a good place for them there. Really appreciate this session, Rafa. It's a different angle for me on how to think about this, and I will definitely be reaching out.
Yeah, please do.
Thanks so much.
I love to exchange more with you and with everyone else as well. Thank you so much, Kate. You again, Dan, everyone for being here. I love being here around Innov8rs, and please feel free to reach out. I'll be glad to talk with anyone. Always happy to.
Fantastic. Thanks, everybody.
Thank you.
Have a great evening.